Hey everyone, welcome back to the Weekend Charts. Charlie Bilello here. As always, I'm going to run through the most important charts and themes that we're seeing in markets today. And we have a lot to discuss, so stick around to the end. And if you're watching this on YouTube, hit that subscribe button for more content just like it. So let's start out by talking about the equity market and this unbelievable decline in volatility. I'm calling it the volatility crash here because that's exactly what has happened here in terms of the VIX. So you could see here 1246 for the VIX ending last week at that level. That was the lowest we've seen since January 2020, so pre-COVID levels in terms of the VIX. And we went from a period of slightly elevated volatility a month ago to rapidly declining volatility, and to the point now where you're seeing very little movement in the major indices. And the last 4 weeks, what a stunning shift that we've seen. A 41% decline in this volatility index. Very rare to see that. This was actually the ninth biggest 4-week decline that we've seen for the VIX in history. The VIX dates back to 1990. And so I just pulled very quickly other time periods that we saw big declines in the VIX. Is that a bearish indicator? Is it a bullish indicator? I'm looking out a year later. Most of the time, the market is higher. But as you know, most of the time the market is higher regardless of what the VIX is doing. But what we can say here is certainly not a clear bearish indicator. It's not the same thing, the VIX going down rapidly as it is going up rapidly. Up rapidly, you tend to see this snapback in the other direction where the market is going down and then it rallies, outsized performance when you have extremely high levels of VIX. You don't tend to see the same thing historically when the VIX gets down to low levels. So, which is another way of saying that people can remain complacent or optimistic for much longer than people expect. And you tend to have these brief periods of fear and panic when the VIX is spiking. And that's more an abnormal situation than what we're seeing today. So, we'll see what happens with volatility going forward. Obviously, can't get too much lower. We did see a VIX below 10 at one point a few years ago, so certainly could go lower, but kind of stunning to see how quickly sentiment has shifted from some level of bearishness a month ago to today. Very few people talking about any concerns. And if we look at the major indices, what have they been doing while volatility has been moving down rapidly? Well, they've been going up in a vertical fashion, especially if we look at the NASDAQ 100 and S&P 500 ETFs. They're now less than 2% away from new all-time highs. So it wouldn't take much here. This is on a total return basis, including dividends. Only a few percent more would get back to those prior highs, and pretty amazing. Nobody entering the year thought that that would happen. Got NASDAQ 100 up well over 40% this year, and S&P 500 on a total return basis up around 20%. Now, is the average stock close to its new highs? Certainly not. We're seeing a very wide divergence. We talked about this all year between the bigger caps, the mega caps, especially large tech stocks this year, and the average stock. And you could see that in looking at the Russell 2000 ETF, IWM, which is still 24% below its prior high. And all tech stocks are not in the same boat. So while Apple and Microsoft and Google and Amazon are having tremendous years, NVDA, of course, and we'll talk about that in a little bit. The high growth stocks that we saw a huge boom in 2020 and early 2021, the smaller companies, they have been hit much harder. Certainly, they were down over 80%. If we're looking at this ARK ETF, ARK Innovation ETF, from its high in early 2021, well, they're still 71% below that prior high. So while they've come back a little bit, they're not hitting new lows here. Certainly a long way to go for the average stock and for higher growth stocks, the smaller end of the spectrum. So if we're looking at money market funds and what has gone on this year, this is some people are saying there's dry powder here, that people have been hiding in money market funds. Why are they saying that? Because 5.73 trillion now in these money market funds. That's a new record again. That's $1 trillion higher than where we entered the year. And of course, it's very appealing to be parking your money here because you have an over 5% rate of return that you could get with no volatility. And so we're seeing money continue to pour into these funds. The question, I guess, would be, when do investors start to get that FOMO? When do they start thinking about taking risk again? And with the indices approaching their new all-time highs. We could see that happen, I guess, in early 2024. Wouldn't be surprised to see that sentiment shift. But for now, a lot of people feeling comfortable. I'll just take 5% in this money market fund. If they have money in checking or savings earning nothing, as we talked about, this is a very appealing option for investors to get an immediate 5% return as long as the Fed doesn't cut interest rates. So let's talk about this really unexpected combination of events that we've seen this year. If you told someone entering the year that all of these things were going to occur in 2023, they'd probably say that you were crazy. But here we are. This is what has happened so far this year. We have higher interest rates, so a pretty good rise in the 10-year yield, and we have higher earnings, or a lot of people are projecting the earnings recession that we saw in 2022 to continue. We have higher stock prices, of course. S&P 500 up over 18% in terms of price return, over 20% in terms of total return. And we have higher multiples, which wasn't supposed to happen whatsoever because interest rates are rising. And a lot of people are saying, well, multiples should contract because of that. And here's a chart illustrating S&P 500 earnings over time and looking at, well, is the multiple contracting? Is it expanding? And you could see here in 2023, we're estimating earnings for Q4 using S&P Dow Jones data here, but we're expected to see a multiple expansion this year of around 9%. That's where it is currently. We got a trailing 12-month multiple on the S&P 500, P ratio of 21.2 times earnings, and the average since 1989 is 19.2. So S&P 500 is trading currently at a premium valuation, even though interest rates have risen pretty significantly this year, and the Fed hiking additional times this year. We've seen actually a multiple expansion this year. So very unexpected to have not only earnings projected to hit a new high here if we're looking at the 2023 total, got the stock market up 18% in terms of price returns, 20% in terms of total returns, and we have multiple expansion all occurring at the same time. So any of the projections for 2024, of course, throw them out because everyone pretty much got all of this wrong coming into 2023. So these projections, obviously very hard to predict what market is going to do and whether multiples are going to expand or contract in a given year. And 2023 has really kind of been the textbook example of how hard it is to predict these factors. But what an unexpected combination of events. I want to talk about exponential growth. If you looked up this term in the dictionary, what you should find is an example similar to what's going on with NVIDIA today. And they just reported earnings again, and the exponential growth continues. So we're actually seeing an acceleration in the year-over-year revenue growth, which seemed impossible, but they're continuing to increase revenues at an ever increasing rate here. So now 206% year-over-year revenue growth, and what they're expecting for Q4 in terms of their guidance, 231%. So the exponential growth is expected to continue here. And what were the actual numbers? Well, $18 billion in quarterly revenue, just a stunning increase. If we look at the lows from last year, they were running around $6 billion in terms of revenue. So tripling that from the lows last year, far above their peak revenue number from before that decline. And again, expected to continue here. They're projecting $20 billion in terms of revenue for the fourth quarter. And that would be almost 20 times where revenue was 10 years ago. So needless to say, this is just an example that very few companies in history have ever done this type of growth, and at this scale, at this size, continuing to execute. And if we look at net income, it's not just sales. This is an extremely profitable company at this point here. We got net income of over $9 billion, which is 3 times higher than where it was previously at the peak. And looking at over the last year, 13 times higher than where it was a year ago. The last decade, the numbers are just unbelievable, 77 times higher than where net income was in 2013. So just unbelievable growth here. And because NVIDIA still is the dominant player in terms of these AI chips, they have the extreme pricing power. They're pretty much selling these things for whatever they want until competitors come into the market. And because of that, their profit margins are exploding higher. Their net profit margin, 51%, a record for NVIDIA in the last quarter, just unbelievably high. Now, competition, free markets would suggest this is not sustainable. Other people are going to come in and try to attack that margin. And that will likely happen, but it's not going to probably happen in the fourth quarter. It's going to take some time for these competitors to jump in. But just stunning example of exponential growth. And we've talked about what NVIDIA stock has done this year, but if we look at the fundamental drivers, it's so far been justified. The question is, can it continue at this rapid growth pace? And are investors paying too high of a multiple, expecting that growth to continue? And so if we look at NVIDIA over the last few months, it's kind of gone sideways. So expectations were extremely high. They've met those expectations, I would say, but the stock is having a little bit difficulty here pushing up to the next level, perhaps suggesting that a lot of this growth is already priced in. So it'll be interesting in 2024 to see if competition starts to take hold and we see a real competitor drive down these margins for NVIDIA. But in the short run here, that exponential growth is likely to continue for at least another quarter. I want to talk about holiday spending here, and if we look at the news surrounding Black Friday and Cyber Monday, so far it's hard to get a read for that. So you have to take it with a little bit of a grain of salt, these articles, because they're throwing out all different numbers in terms of projections. But so far it seems to be pretty good by all accounts. And what this survey indicated from Deloitte here is that people are expecting to spend more money, which is kind of unusual, because if you ask people if they're going to spend more money on the holidays, they're usually don't admit to it. They're usually very tempered in terms of their expectations, and then they end up spending more than they expected to. What's different this year is people are saying they're actually going to spend a good amount more, actually 13.5% increase from last year. The average U.S. consumer is saying they're going to spend around $1,652 this year. So very interesting to see that from this survey, where again, consumers very rarely admit to spending more than they did, or a lot more than they did a year ago. And here we have 13.5% increase. Now, what are some of the reasons why the U.S. consumer might be feeling comfortable increasing their spending this year? Well, I'll run through a few things here. First, we have the jobs market, continued strength there, 34 months of payroll growth. That's expected to continue when we get the next report. So job market still on the tighter side, although it has loosened considerably this year, but that has people feeling good. We have the fact that hourly earnings are still going up over 4% over the last year. And as we talked about, that's outpacing now inflation. So that has people feeling much better about things, because when wages weren't keeping pace with inflation, that was leading to really negative sentiment about the future. And now that their earnings are outpacing inflation, people feeling much better. We also have this tight labor market leading people to have more confident that they're going to retain their job. And so if we look at the survey here, asking consumers what's the probability of losing your job in the next 12 months, it's currently at 12.7%, which is below where we were, still below where we were pre-COVID at 14.3%. So if you're feeling more confident that you're going to retain your job, that your wages are going to increase, you're more likely to spend money. And then we have the final factor here, and this has been very hard for people to estimate. And every time people kind of thought that this money had run out, there would be a new analysis saying, no, look, there's still excess savings. This is a chart trying to estimate what the excess savings that U.S. households have had since the 3 rounds of stimulus in 2020 and 2021. As you can see, at one point in 2021, it was over $2 trillion, and slowly that's been going down. But still, the San Francisco Fed is saying there's still $433 billion sitting there for U.S. households to access if they want, in terms of spending that money. And perhaps that's an additional factor that's going to lead up to a boost in terms of holiday spending. So I think all of this should be good news to at least see decent numbers of this holiday season. I think the bigger question maybe won't take hold in the next few months, but the bigger question is, when is the rising credit card debt, rising delinquencies, when is that going to start to become problematic? We've talked about the average interest rate on credit card debt over 21%. So what I would say here is for those consumers that have very high credit card debt and are finding it increasingly difficult to service that debt, they're certainly likely to pull back. But that's not yet a huge percentage of the overall consumer market. If we look at delinquencies, yes, they've risen. They're approaching 3% in terms of credit card delinquencies, but that's actually still below the historical average, even though it's the highest since 2012. So I think this would have to rise even more before we start to see that have a real impact. And those without credit card debt that we've talked about, that have those money market mutual funds or have money in high yield savings account, well, now they're earning over 5% on that money, and they don't have this floating rate debt that's problematic. So those people, that's likely to cause a boost to consumer spending for those people. So it's really a bifurcated market with where overall most people are in a position to spend more than they did a year ago. And so it should be a pretty good holiday season if these expectations are correct. So I want to talk about the housing market and a different look here, looking at the average size of a house today versus 1970 and just how much more excess space we have today than back then. So here's a good chart illustrating here the shift in terms of extra space, extra bedrooms. 34% of households today have two or more spare bedrooms versus 13% in 1970. So huge increase in terms of number of extra bedrooms. One of the driving forces of that is obviously bigger homes being built over this period of time. The other factor is that many seniors today are not downsizing in retirement, they're aging in place. And so obviously their kids have moved out, they still have these extra bedrooms, and now 17% of seniors have two or more spare bedrooms as a percent of housing, and that's up from 5% in 1970. And if we look at this chart here, this really illustrates the shift here. 1970, you had 49% of homes with three or more bedrooms. Today, 63%. And at the same time that homes have been getting bigger, we've actually seen the household size go down. So fewer people are living in these homes. Now you only have 38% with three or more occupants in these homes, but you have bigger homes. So this is something that's not often measured in terms of the housing market. It's obviously a sign of increased prosperity for the U.S. and U.S. economy. The fact that we now have bigger homes, more space in these homes. So it's not comparable to say, look at this home in 1970, look at the price of the home, and look at the price today. You have to really adjust for that bigger size. And the fact that we have all of this extra space obviously means that Americans are doing better today. Otherwise, they would have to be forced to downsize or be forced to buy a smaller home. We'll actually talk about that in a little bit in terms of new homes and what's going on there in terms of the lack of affordability. But very interesting to see this shift in terms of Americans want bigger homes. They're obviously spending more time in the home as well, particularly today, working from home more or a hybrid model. And so that demand has really persisted. And at the same time, we've seen the household size actually go down. So I want to talk about the Argentina election that took place. And we talked about this a few weeks ago. But now we have the outcome here. Javier Milei actually won the election. This was the libertarian candidate that I was talking about, has a lot of different ideas. And Argentina ultimately elected him, I believe, because they want to try something new. And what do they want to try something new for? Well, it's because things weren't going very well at all. If we look at the Argentine peso versus the US dollar, it lost 98% of its value over the last 10 years. Just a stunning collapse in terms of the currency. And one of the big reasons for that is the hyperinflation that's going on in Argentina, estimated at 179% inflation rate this year. That's far above its peers in Latin America. And if we look at the Argentinian economy, we've seen just a series of deep contractions over the last 40 years in terms of big economic recessions that exceeded a 10% decline in terms of real output. So, a lot of reasons for people to be feeling negative. And what Javier Milei has promised is to try to change things, shake things up. As we talked about a few weeks ago, he wants to dollarize the economy, so shift to the US dollar in terms of the primary currency for the Argentinian economy. He wants to cut government spending significantly, which in terms of public spending as a percentage of GDP, above 40%, so relatively high if we're looking at Argentina versus other countries. He wants to cut a lot of that. He wants to really attack inflation. He wants to also end the central bank there. We'll see if all these things can happen, but what people are hopeful for is that inflation rate will come down as a result of these policy changes, and we'll see more investment in terms of foreign investment into the Argentinian economy. And if we look at Argentina right now in terms of foreign investment, it's really at the lowest amongst its peers, only 1% as a percentage of the economy. And so, what has the market's response been so far? If we look at the MSCI Argentina ETF, it's been very, very good. 20% rally since the election results. So, looking at the MSCI Argentina ETF, really one of the standout performers this year in terms of the return. And so hopefully this will bring about a meaningful change for the Argentinian people. Definitely, we're not trending in the right direction. So hopefully some of these policies will actually counteract what has been going on and really bring down that rate of inflation, lead to more stability in terms of the currency, and just create more prosperity for the Argentinian people. So let's talk about the housing market standstill, which continues here. If we look at existing home sales, we have the lowest level of existing home sales since now 2010. And so it's actually below the levels of COVID, where no one was really going out looking for homes during that brief period during COVID in April and May of 2020. So below those levels. So same reasons that we've talked about. Why aren't people purchasing homes? Well, like, they can't afford those homes, and there's very few people selling their current homes that they live in because they have these low mortgage rates that they're locked into. They don't want to give those up, and if they were to buy a new home at a higher mortgage rate, they wouldn't be able to afford that home. So we have this crazy situation where prices are remaining elevated because we have a very low inventory of existing homes, and we have very few sales being contracted because you have very low demand and very low supply. So if we look at the year-over-year rate of change in terms of home sales, down 15% from a year ago, that's the 26th consecutive year-over-year decline, which is the longest down streak we've seen since 2007 to 2009. And that recent spike in mortgage rates, where we saw mortgage rates run up to around 8%, really led to a lot of people to cancel their purchases of homes. We saw 53,000 homes canceled in October. That's 17% of all homes in contract, and that was the highest percentage on record. So a lot of forces working against the housing market or activity in the housing market. But the good news, if you're looking to buy a home and you've been waiting, it seems like the supply situation is slowly moving in the right direction here. We have existing home sales. The month supply is up to 3.6, still low compared to the historical average around 5.3, but moving in the right directions. Is the highest since that we've seen since June 2020, and more than double what we saw in January 2022 when these inventory levels hit an all-time low. So if this keeps stabilizing, what you should see is more activity in the market. More supply is going to also help with affordability, put a lid on prices, or help bring down prices. That should lead to more activity as well. But for now, still a standstill, but hopeful here that we're moving in the right direction in terms of inventory and supply. I want to talk about the economy. A very short recession is what the Conference Board is now predicting in 2024. And looking at their leading index here, you can see It's been in the negative territory here 19 months in a row, which is the longest down streak since 2007, 2008. And as we talked about last month, the conference board has been predicting a recession for quite some time now. They originally said it was going to happen in the first quarter of this year. When that didn't happen, they pushed it back to the second quarter, then the third quarter, then the fourth quarter. And now they're saying at some point in 2024, there's going to be a very short recession. And what are they relying on? Their leading indicators, which include the inverted yield curve, include some of the housing statistics that we've talked about in terms of lack of activity there. They're looking at also ISM manufacturing data, new orders data, and they're also talking about the U.S. consumer pulling back and that being the driving force. And on that front, we are still seeing interesting here because this kind of contradicts what the expected holiday spending is supposed to show a boost. But if you look at this University of Michigan Consumer Sentiment Index, U.S. consumer is still pretty negative here, which is kind of remarkable, given given that they still seem to be spending money, and especially on experiences. We have 28 consecutive months now where this consumer sentiment index has been below 75, and that ties the record for extreme negative sentiment from 2008 that we saw from 2008 to May 2010. So this has been an incredibly long period of negative sentiment without so far a recession. And so question is, are these consumers just saying that they're negative, but they're actually going out and spending money, or are they really going to start to pull back because of this negative sentiment about the economy? We'll see what happens with that. And typically, this is what's unusual. Typically, this kind of follows the stock market pretty closely. And with the rebound that we've seen in stocks this year, I would have expected to see more of a rebound in this index, and especially with the US inflation rate coming down the way it has this year. So this might be an outlier, and perhaps don't watch what people say, watch what people do. There's that saying, but it's just stunning. Kind of from a contrarian perspective, I guess you could say this has been a positive because people have been negative, but stocks are climbing that wall of worry. But if you look at this historically, when it's been down this long, eventually it has led to some economic weakness. Perhaps this will be the outlier that we talk about in years to come. So there's a new king of shipping in town, and you're probably not surprised at who it is, but you should be surprised at how quickly Amazon has taken this title. If you look at just a few years ago, Amazon was trailing both UPS and FedEx in terms of the number of packages that were shipped each year. And today, in 2023, they're expected to be the number one shipper in America. 5.9 billion packages are expected to be shipped by Amazon this year. And UPS is expected to be kind of flat over last year at 5.3 billion parcels. So Amazon controlling their own destiny here. Many people said it was going to take decades for Amazon to catch UPS and FedEx. I was just reading an article from 2018, which was outlining all the reasons why Amazon wasn't going to catch up with UPS and FedEx that quickly, and Amazon has beaten all of those expectations, and then some, and now is the biggest private shipper in America. So let's end here, as we always do, with positive news, and that's lower priced new homes is a welcome sign for anyone, especially new home buyers. First-time home buyers have been waiting for lower price homes. As we talked about, affordability as at record lows. So this is a very good sign for anyone waiting to buy a home, particularly first-time home buyers. The median price of a new home sold in the U.S. is now down a little over 17% from its peak. And if we look at the last housing bubble, we saw a 22% decline. So pretty sizable decline so far in terms of the median home price. And what's driving this? Why is it going lower? Well, there's two big factors. Number one is, unlike the existing home sale market, the new homes market, we're seeing elevated inventories. And we talked about this last year, where we had inventory, the month supply over 10, which is something you rarely see and is often associated with price decline. So not shocking to see prices come down over the past year, given that huge rise. But we still have inventories above their historical averages today at 7.8 versus 6 is the historical average. So we have more supply in terms of this new homes. The builders are then incentivized to cut prices to get people to be able to afford these homes. And the second big factor is the builders are actually building smaller homes. So we talked about earlier, there's been a trend over the last 50 years where the size of a home has increased significantly. Well, as it turns out, those 4-bedroom homes are a lot costlier than 3-bedroom homes. So what we're seeing is an increasing share of new homes being built are smaller and thereby more affordable, especially for first-time home buyers, and especially given the rapid price increases and the high mortgage rates. So good news for home shoppers, trend that hopefully continues. And as long as supply remains elevated, I suspect that it could in the next few months are seasonally weak for the housing market as well. So we could very well see a 20% decline in these new home prices at some point in the next few months. So with that, we'll end it right there. Have a great week, everyone. Thanks for joining me. As always, if you like the content, subscribe to the channel, and I'll see you next time on the Weekend Charts.